Okay, so the question on hand that we have is whether Warren Buffett's strategy would continue to work for the next 50 years. A very good question, I think, and I'm so happy that you are asking this question. So I think his strategies are of rational mind. And what is Warren Buffett looking at? See, when he is speaking, you'll have to understand first the nature of Warren Buffett. The message gets lost here. When he writes in the shareholders annual shareholders report or in the annual report, he writes a very complicated language. Okay? So you don't understand his investment strategy. Point number one. So we were told in our MBA schools or MS schools, or business schools, that read as many shareholders report addressed to the shareholders of Warren Buffett to understand his. But it's complicated. It's not easy to make. Second, his nature is when he visits MBA schools, when he's speaking to the students, then he's always joking around. He's giving you such, you know, uh, statements that you would find that, oh, one, it is, these are light-hearted statements, and you think, wow, it has a wow factor. It has you get influenced by that. Wow, this is how you should think. But between this, somewhere lies the real truth. If you really follow him, they are investing in natural monopoly business. Okay. For example, in India, all government businesses, they have natural monopolies. So if it is efficient, meaning what? If it is both operationally and there is operational efficiency and there is capital efficiency, then natural monopolies would make sense for thousands of years. It will always make sense. है ना? तो इतना बड़ा स्केल कर लिया आपने, you are such a major market shareholder that you have a natural monopoly, not a government monopoly, because his investment is less in government companies, it is more in companies which have major market share. Coca-Cola has a natural monopoly. Sears Candy has natural monopoly. His railroad investments have natural monopoly. His investments in reinsurance companies have natural monopoly. So we should understand what is natural monopoly. We should conduct a case study on natural monopoly. It is not a government monopoly he's talking about. He's talking about natural monopolies. So will it work? Yes. Then he talks about his primary focus is efficient capital allocation. Whatever matrix you use it, he says, ignore all your jargons, ignore all your matrices that you've been using so far to an extent, and listen to it very carefully, that he says that this is a shitty method of looking at profit margins. This is on record. No professor, no investment manager on this planet would have ever courage or would be courageous enough to criticize EBITDA margin. Just go and research what both of them said about EBITDA margin. Okay? We started investigating. His point is correct that you should not look at EBITDA metrics. You should look at some other metrics which correctly measures it. Okay? But this is not true when you introduce lease accounting in this. Then the only matrix is which is correct is EBITDA matrix. So you'll have to read about IND AS 116. We are working on that. We are doing a case study for that. All your QSRs, quick service restaurants, like Domino's, KFC, McDonald's. If you look at EBITDA matrix, then only you get the true picture, because all the lease accounting that you are doing for the next 30 years goes to the capital, gets added on as an asset side and the liability side. A lease sits as an asset and as a liability, and depreciation and interest is charged as if this is an asset. It is a lease. I have rented this place for the next 30 years and it is not being charged as rent. It is not being accounted in EBITDA. It comes as interest and depreciation below this line. So the only correct, so you will always see that this company is making a lot of money. This is generating a lot of cash. But when you look at the PAT margins, you will see it is a loss making. You'll go crazy. How is this company surviving for the last 10 years? and it goes on expanding, and not expanding one or two stores, 250 stores in 1 year. 2025, a particular brand has opened 250 plus stores, signed leases for that. How will you survive that if you're not making money? So the only correct matrix is EBITDA. But listen to what he says. He says EBITDA is not a correct matrix because depreciation is an actual cost, whether paid in advance or whether charged every year. It is not a non-cash charge. Look at his thought process. The entire accounting is saying that depreciation is a, what they teach you? Depreciation is what? Non-cash charge. Do you call this NCC? Non-cash charge? Warren Buffett questions that. You blow your mind off and he says, no, this is a charge. This is actually exactly right, because you have spent 100 crore on that asset. All you are doing is splitting the cost over 10 years. Under the SLM method, 10 years, every year you are charging, and you are saying don't charge it to the EBITDA. He says it is absolutely foolish methodology. So Warren Buffett's methodology will survive because it is absolutely rational and blows your mind off. He sort of, shakes the accounting world, he shakes the financial concept, and he says, I will look at what is being charged. So the best metrics to look at is obviously is the cash flow. Whatever you have actually spent, you depreciation. EBITDA it is not removed. EBITDA is here. No? EBITDA is here. Okay. You have to minus from there. You have to remove from there. Tax are you paying? Yes. Tax is a cost. Yes. Is depreciation are you paying? Or for intangible assets are you paying amortization? 100% yes. Is interest not a cost? Yes. He's saying that this matrix is not correct. And if you pick up any of those professional degree, they will say EBITDA is the best matrix, EBITDA is the best matrix, EBITDA is the best matrix. So this guy has got the mind. A normal human cannot question that. And he's talking to international press, and he says it's absolutely bogus methodology. Don't. And he says both of them. He says, Charlie, what would you say? He says it is shitty. That's what the word they don't call it crap. So will Warren Buffett's way of looking at investments? 100% yes. They are looking at one, companies which are natural monopolies. Second, they are looking at the best of the capital allocation. All their matrices are driven by the actual cash flows. EBITDA is not the actual cash flow. Please understand. Because have you paid tax for this year? Are you going to pay tax? Yes. Depreciation, you have paid 100 crores in advance, and every year you are going to charge, but you are not accounting an EBITDA. So that is, he's saying this is not. So his methodology, yes. So I think he's leading you more towards the cash metrics rather than the operating metrics. So he's taking how much cash you make. If you're making enough cash on year, then he will look at how much you can make in the US. So are you making 4 to 6%? If I'm making 10 to 12%, I am happy with it. But a cash matrix, how much you are actually earning, actual earnings. So that's why he criticizes. Answer I think is yes, But it is layered between his investment style and his the style that you see of speaking, which is very light-hearted at times, but not on at Omaha, the Nebraska, the shareholders meet. There they are very serious. There they will give you such a gyan that you'll get confused. But in colleges, his personality is very different. 100%. Yes. We have written a paper on that. We have a paper on that. We have, in fact, analyzed everyone's investment style. So whether it is, I think, Jonathan C. Graham, or whether it is Warren Buffett, or whether it is Peter Lynch, or whether it is maybe the Rothschilds. So every investment, uh, it works in the this cycle. No, it works here. It works here. Where you find cheap companies which are rationally priced before right after recovery. This is recovery stage. So Warren Buffett works in recovery stage. That's the best. Ah, so he works in the recovery.
He sees that whether the company can raise again. It's falling now. Again, can raise
His about his idea is only about rational pricing. Huh. So they are waiting for this stage. The peak of the recession. But he says that. In fact, the US markets are going up, the Korean markets and Taiwanese markets are going up. So it is not corrected. And there is a video where he says that the markets have only corrected 5-7%. That's not a correction. So he's sitting on a cash, he's waiting for this. And Charlie Munger was dead against the president of the United States. Someone asked him that how do you see Donald Trump as a president? And he speaks and he says, I should not speak, go on just speaking about it. So he says that I'll just stop here. So he's dead against, he said that he's flamboyant is the word that he uses, something like that. So this is the stage when then there are these guys who focus on momentum, which is your expansion stage. So some of the theories or theorists or the professors focus here. This is the best time, and this would survive because you are getting the asset at a cheaper cost. Absolutely, and lot of inefficient companies. See, why are economic downturns? Because it wipes off inefficient companies. During this stage, inefficiency will go away. So market will bless inefficient companies in the sense it will wipe off. So you know that if this company has survived, and you will have to see how many cycles it has survived. See, Coca-Cola was founded, I think, 1950s or maybe earlier, maybe much earlier, much earlier, I think. I think maybe it had already been correct. You're right. So maybe almost it was 50, 60 years old company, maybe 100 years old. Just check the history of it. So when Warren Buffett picked up the stock, I think in 1950s, if I'm not mistaken, this company had already seen many downturns. Great Depression, the World War I, the World War II, so many downturns they had already seen. So he picked up this. And his whole logic was that they sell about a billion Coca-Cola cans a day. That was his logic. So his metric is the cash flow metrics. And his real investment, the main investment has come from reinsurance companies. So what funds his investment theory is the cash which is being generated by these reinsurance companies, Geico being one of them. So if you go to US, you will see that there are Geico balloons, the huge balloons that you see fixated on the top of the building. You can see from the end of the city. So Geico, GEICO is one of those. So reinsurance. So he is a very smart in that sense that he's picking up companies which are generating a lot of cash. That cash is going to Berkshire Hathaway. From there, they churn a lot of capital. They are making returns on the equity, and that he's deploying it in another company. And he has burned capital. He's burned capital out of ego also. He has said that they were negotiating a deal, and it was just the price of the share was only more by the higher the return offer that came was higher by 3/4 for the 35 75 pennies, and he went and bought that entire company, and then he realized that he was possibly burning cash there, which was not a good decision, so they had to change the whole company. Berkshire Hathaway also was a very different company initially. It was not the company, so they bought. So there his thought process has changed. It is influenced by Charlie Munger on the good side because he is a guy on the probability side of it. Emotions away. There are no emotions in investments. So that's why he's a better investment because of Charlie Munger. So will his theories exist for the next 50 years? Absolutely yes, because he's buying, and you know that this is a basic principle. Whether you had listened to Warren Buffett in 1 AD, first AD, or 100 AD, or 100 BC, before the Christ, after the Christ, thousands years after the Christ, 1,000 years before the Christ, whichever um, period you were looking at, you know that this is a golden principle that if you buy cheap, the possibility of failure reduces, the probability of default reduces, and you tend to make money. That's the whole principle. So he says, I will buy companies at 50% cheap. He's not selling. He's only selling when the company is not from this cycle, the economic cycle. You know, you come to the company's cycle. From the economic cycle, now you come to the economic cycle of the company, the business cycle, and from there on, you also go to the product cycle, life cycle. It is similar. So economic cycle, when do you pick up? You pick up somewhere here, right? The cheapest company, the company is trailing or trading cheap at this point in time. Okay? And then if the product cycle is not like this, then you will not pick up this company. Look at the major products. If the product cycle is on a downturn, typewriters, digital things, है ना? Anything which is dying out, petrol cars, diesel cars for sure, gone in a day. But there was noise from 2016, the diesel cars would be dead. The best car is a diesel car to drive, the fun. But if you talk about the emissions and the environment part, so while you can buy a company, you can pick up a company in this stage, you can look at, you can pick up economies in this stage, you can pick up companies in this stage, you cannot pick up products here. A dying product you cannot. So this is where you will pick up, but ensure that the product is a growing product. Now, watch it for 3 quarters. If it is not performing, maybe it gives you a reason to exit. So that is the only reason why they exit. They look at couple of quarters, 3 quarters, 4 quarters, whatever. It all depends on their fund manager. They are not going to disclose it. And now they have a new fund manager who's the CEO. So and they'll have different fund managers. So if the product is on the downturn, if the company is not performing, has been many quarters, maybe 3 quarters minimum, then you have a reason to. More than that, more than that, they should have that. It's a long term, so it's not about just quarters. Quarter is just your sentiment. When you have already invested, you are watching it whether their company is going good or not, whether the EPS is growing or not, and whether the product is performing or not. Ever they have a feeling that EPS is not growing on a forecasted basis, or the product is going on a downturn, they'll be happy to trim or completely exit. But which quarter, how many quarters, and that is not known, but they will trim. For example, in one of the fintech companies in India, they invested 2 years ago. Prior to the listing, on the date of listing, they exited, and they booked a loss of, I think they partly exited on the day of listing, and so they booked a loss of 1350 crores. So all this idea that they hold for life is wrong. All that idea that they do not invest in technology companies is wrong. Charlie Munger taught him that you should pick up good companies at a higher price. You should be open to that. That is why they bought Apple maybe 40 years later. Apple got listed on NASDAQ. NASDAQ was formulated as an exchange only for these companies which cannot get listed on NYSE, because NYSE had stricter listing norms and they wanted to raise capital. So all the tech companies which came in 70s, IBM, Microsoft, they came in 50s, but they started maturing. IBM came much earlier in 50s, but Apple, Microsoft, Bloomberg, all these tech companies started maturing in 1970s and started raising funds in that period. NASDAQ was made for that. It was a national association for stockbrokers, automatic dealers quotation or something, that was the name. So they exit. He invested in Apple, exited in Apple, does not hold for long term. The quote says, when I was reading, this is 20 years ago, his famous quote was, marry a stock as if you marry for life. That is the time when he's speaking about when divorces were not common in the US. Now divorces are very common. They both of them are married to their partners and not divorced yet, and that is like a 30, 40, maybe 50 years of association. So he's talking from a very different, so his statements are all mixed up. Now that is not true. They do sell. Their investment strategies are also undergoing change. They invest in tech companies. They look at quarterly this thing. If they have reasons to believe the product will not perform or the EPS will go down, they will be very happy to trim or completely exit. When and what, that's their investment strategy, which we can study. We can study a case study. Whenever they have trimmed the stock, what was the reason? We can conduct a study on that.
Product should be at this, but the company
Product should be here. Expansion. If it is a peak, then you know that you're going down. or it should be an evolving company. They should have a good R&D. They should keep evolving, and every company goes through a product failure also. The other thing that I teach is, which is important to understand, is you have to see at their previous product launches. That they are not teaching in any finance class. The product launches, how they are good with product, because all product will not succeed. Will not be 100% success. Some products will go through failures. How they have managed, how they have managed their product failures, you know. Correct. And it is the DNA of the company, because the chairmen will come and go, the professional ones, the MDs and CMDs will come and go, the product and the pricing team and the marketing team will come and go. How as a company has survived. So it is not person specific. In the last 30-40 years, study their, write down the assignment, study the product failures.
Like every company or every product has its common curve. First six with launch time, growth, maturity, and decline.
Right.
So this is very common for
every product goes through the cycle, but you have to keep evolving, so you have to keep launching new models. So that's why I'm saying, so you have to study the product failures and how successfully they have to manage their product launches. Also understand the growth rates they have experienced. Write down. This is also a group study. What kind of growth rates they have experienced in their product launches. समझे आप? What kind of, write this very carefully, underline this. What kind of growth cycles, the growth rates they have experienced through their product launches, right from the launch until their decline. Various, I will talk about it. I am talking, the reason I am talking about this one is, write down very carefully, I am linking it to the sustainable growth rate. So you will measure all the product launch growth rates. From the launch, you will see a J curve, a peak. It will go like this. This is known as a J curve growth. Then it will come down here. So from here to here, what was the product growth that you identify in that program? Okay. Now, yes, next question. ठीक है ना? So we'll